Have you ever wondered what really happens if you don't file your tax returns? Many people think skipping a year or two isn't a big deal, but the reality is far more serious than most realize. In this video, we'll walk you through the step-by-step consequences of not filing your taxes, from missed deadlines to escalating penalties, and even the possibility of criminal charges. Whether you're self-employed, a salaried worker, or someone who just forgot, understanding these outcomes is crucial. Let's start by exploring why tax filing is so important and what the government expects from every taxpayer. Filing your tax return isn't just a bureaucratic formality, it's a legal requirement. The government relies on tax filings to fund public services, infrastructure, and social programs. When you file, you're not only fulfilling your civic duty, but also ensuring you're in compliance with the law. Failing to file can disrupt this system and trigger a series of consequences. In the next scenes, we'll break down exactly what happens when you miss the deadline or skip filing altogether. The first thing that happens when you don't file your tax return is missing the official deadline. This might seem harmless at first, but it's the starting point for a chain reaction of problems. The IRS, or your local tax authority, immediately notes your non-compliance, and you may lose out on potential refunds. Missing the deadline also means you're now subject to late filing penalties, which can add up quickly. Let's see what those penalties look like. Once you've missed the tax filing deadline, late filing penalties start to accrue. Typically, the IRS charges a percentage of the unpaid taxes for each month your return is late, up to a maximum limit. These penalties can quickly become substantial, especially if you owe a significant amount. The longer you wait, the more you'll owe, making it harder to catch up. This is just the beginning, as interest also starts to accumulate on top of these penalties. In addition to penalties, interest begins to accrue on any unpaid taxes from the day after the filing deadline. The interest rate is set by the IRS and compounds daily, which means your debt grows faster the longer it remains unpaid. This can make a manageable tax bill balloon into a much larger financial burden over time. The combination of penalties and interest can be overwhelming, so it's important to act quickly if you've missed the deadline. If you're owed a refund but don't file your return, you risk losing that money altogether. The IRS gives you a limited window, usually 3 years, to claim a refund. After that, the money is gone for good. This is especially important for people who have overpaid taxes or are eligible for credits. Not filing means you're essentially giving up your own money, so it's always in your best interest to file, even if you think you don't owe anything. When you don't file, the IRS or your local tax authority will start sending you notices. These letters will remind you of your obligation and warn you about the growing penalties and interest. Ignoring these notices won't make them go away. In fact, it can make things worse. The IRS keeps detailed records and will continue to pursue you until the issue is resolved. Responding promptly can help you avoid more severe consequences down the line. If you continue to ignore the IRS, they may file a substitute return on your behalf. This is called a substitute for return, or SFR. The IRS uses information from your employers, banks, and other sources to estimate your income and tax liability. However, they won't include any deductions or credits you might be eligible for, which usually results in a higher tax bill. This substitute return is rarely in your favor and can lead to even more penalties. Once a substitute return is filed, the IRS will formally assess the tax they believe you owe. This assessment becomes the official amount due, and you'll receive a notice demanding payment. At this point, you lose the opportunity to claim deductions or credits for that year unless you file an original return to replace the substitute. The assessed amount is often much higher than what you might actually owe, so it's always better to file your own return. If you don't pay the assessed tax, the IRS will begin collection actions. This can include wage garnishments, bank levies, and even property seizures. The IRS has broad authority to collect unpaid taxes, and these actions can have a major impact on your financial life. Wage garnishment means a portion of your paycheck is sent directly to the IRS, while bank levies allow them to take money directly from your accounts. Property seizures are rare but possible in extreme cases. Wage garnishment is one of the most common collection tools used by the IRS. If you don't pay your taxes, the IRS can legally require your employer to withhold a portion of your paycheck and send it directly to them. This can continue until your debt is paid off or you make arrangements with the IRS. Wage garnishment can make it difficult to cover your living expenses and can be embarrassing if your employer is involved. A bank levy allows the IRS to take money directly from your bank accounts to satisfy your tax debt. You'll usually receive a notice before this happens, giving you a short window to respond or make arrangements. If you don't act, the IRS can freeze your accounts and withdraw the funds needed to cover your debt. This can be a shocking and disruptive experience, especially if you rely on those funds for daily expenses. In rare cases, the IRS can seize your property to satisfy unpaid taxes. This could include your car, home, or other valuable assets. Property seizure is usually a last resort, but it's a real possibility if you ignore all other collection efforts. The process is stressful and can have long-term consequences for your financial stability. It's always better to address tax issues before they reach this stage. A tax lien is a legal claim the government makes against your property when you fail to pay your tax debt. This lien can affect your ability to sell or refinance your home and can damage your credit score. Tax liens are public records, so they can also impact your reputation and financial opportunities. The best way to avoid a lien is to file and pay your taxes on time or make arrangements with the IRS if you can't pay in full. A tax levy is the actual seizure of your property or assets to satisfy a tax debt. While a lien is a claim, a levy is an action. The IRS can levy bank accounts, wages, and even physical property. You'll receive multiple notices before a levy is enforced, but if you ignore them, the IRS will proceed. Levies can be financially devastating and are difficult to reverse once in place. Unpaid taxes and tax liens can have a significant negative impact on your credit score. This can make it harder to get loans, credit cards, or even rent an apartment. A lower credit score can also mean higher interest rates and less favorable terms on any credit you do receive. The effects can last for years, even after you resolve your tax debt, so it's important to address issues as soon as possible. In some cases, failing to file your tax return can affect your eligibility for government benefits. Programs like Social Security, Medicare, and certain welfare benefits may require proof of tax filing. Not filing can delay or reduce your benefits, making it harder to access the support you need. This is another reason why staying current with your tax obligations is so important. If you or your children are applying for federal student aid, not filing your tax return can be a major obstacle. The free application for federal student aid, FAFSA, requires tax information to determine eligibility. Without a filed return, you may be denied aid or face delays in processing. This can impact your ability to pay for college and limit educational opportunities. Owing a significant amount in unpaid taxes can even affect your ability to travel. The IRS can notify the State Department, which may deny your passport application or revoke your existing passport. This is typically reserved for those with large, seriously delinquent tax debts. But it's a real risk if you let your tax issues go unresolved. International travel could be off the table until you settle your debt. While most tax issues are civil matters, in extreme cases, not filing your tax return can lead to criminal charges. Willful failure to file is a misdemeanor, and in cases of fraud or evasion, it can be a felony. Convictions can result in fines and even jail time. While prosecution is rare, the risk increases if you repeatedly ignore your obligations or attempt to hide income. Normally, the IRS has a limited time to audit your tax return, usually 3 years. However, if you don't file at all, there's no statute of limitations. This means the IRS can pursue you indefinitely for unfiled returns. The longer you wait, the more difficult and stressful it becomes to resolve the issue. Filing, even late, starts the clock and can help you move forward. It's not just the federal government you need to worry about. Many states have their own tax filing requirements and penalties for noncompliance. State tax authorities can also impose liens, levies, and other collection actions. In some cases, state penalties can be even harsher than federal ones. It's important to stay current with both federal and state tax obligations to avoid double trouble. If you hold a professional license like those for doctors, lawyers, or contractors, not filing your tax return can put your license at risk. Some states require proof of tax compliance to renew or maintain your license. Losing your license can mean losing your livelihood, so it's critical to stay on top of your tax filings if your career depends on it. For business owners, not filing tax returns can have even more severe consequences. The IRS can shut down your business, revoke licenses, or seize business assets. You may also lose the ability to secure loans or contracts, and your reputation can suffer. Staying compliant is essential for keeping your business running smoothly and maintaining trust with clients and partners. If you're self-employed, not filing your tax return can be particularly risky. You may lose access to important tax deductions and credits, and the IRS may estimate your income much higher than it actually is. This can result in a larger tax bill and more penalties. Self-employed individuals are also more likely to be audited if they don't file, so it's especially important to stay compliant. Not filing your tax return increases your chances of being audited. The IRS pays special attention to non-filers, and your case may be flagged for further review. An audit can be time-consuming, stressful, and may uncover additional issues that lead to more penalties. Filing on time, even if you can't pay in full, reduces your audit risk and shows good faith to the IRS. If you don't file your return, you can't set up a payment plan with the IRS. Payment plans are only available to those who have filed their returns, even if they can't pay the full amount right away. Not filing means you lose the opportunity to spread out payments and avoid more severe collection actions. Filing, even late, opens the door to payment arrangements and can help you manage your debt. Not filing your tax return means you can't claim valuable tax credits, such as the Earned Income Tax Credit or Child Tax Credit. These credits can significantly reduce your tax bill or even result in a refund. Missing out on them is like leaving money on the table. Filing ensures you get all the benefits you're entitled to and can improve your financial situation. Not filing your tax return can affect your entire family. If you're married and file jointly, your spouse may also be held responsible for unpaid taxes. Family finances can be strained by penalties, interest, and collection actions. In some cases, children's eligibility for benefits or student aid can be impacted. Staying current protects your loved ones from unnecessary stress and hardship. If you owe back taxes, the IRS can withhold future tax refunds to cover your debt. This means that even if you file in later years and are due a refund, you may not receive it until your previous debts are paid off. This can make it harder to catch up financially and creates a cycle of missed opportunities. Lenders often require proof of tax filing when you apply for a mortgage. Not filing your tax return can make it difficult or impossible to buy a home. Even if you qualify, you may face higher interest rates or less favorable terms. Filing your taxes on time is an important step toward achieving your homeownership goals. Some insurance companies require proof of tax filing for certain policies, especially if you're self-employed or applying for business insurance. Not filing can delay or deny coverage, leaving you unprotected. This is another reason why staying current with your tax obligations is so important for your overall financial security. The stress of knowing you haven't filed your taxes can take a toll on your mental health. Worrying about penalties, interest, and possible legal action can cause anxiety and sleepless nights. Filing your return, even if it's late, can bring relief and help you move forward with confidence. If you can't pay your taxes in full, the IRS offers several payment options, including installment agreements and offers in compromise. However, you must file your return to qualify for these programs. Filing opens the door to manageable solutions and can help you avoid more severe collection actions. If you've missed filing one or more tax returns, it's not too late to catch up. Start by gathering your documents and filing as soon as possible. The IRS is often more lenient with those who come forward voluntarily. You may be able to reduce penalties or set up a payment plan. Taking action now is the best way to resolve the issue and regain control of your finances. If you're overwhelmed or unsure how to proceed, consider seeking help from a tax professional. Accountants and tax advisors can guide you through the process, help you understand your options, and communicate with the IRS on your behalf. Professional help can make a big difference, especially if your situation is complex or you owe a significant amount. The IRS offers a Fresh Start program to help taxpayers get back on track. This program provides options for payment plans, penalty relief, and even settling your debt for less than the full amount owed. To qualify, you must file all required returns and communicate with the IRS. The Fresh Start program can be a lifeline for those struggling with tax debt. Coming forward voluntarily to file your late returns can work in your favor. The IRS is more likely to reduce penalties and work with you if you take the initiative. Voluntary disclosure shows good faith and can help you avoid more severe consequences, such as criminal charges or aggressive collection actions. If you owe more than you can pay at once, the IRS offers installment agreements. These allow you to pay your tax debt over time in manageable monthly payments. You must file all required returns to qualify. Setting up an installment agreement can help you avoid wage garnishments, levies, and other collection actions. An offer in compromise allows you to settle your tax debt for less than the full amount owed if you meet certain criteria. This option is available to those who can't pay their full tax liability due to financial hardship. You must file all required returns and provide detailed financial information. The IRS will review your case and may accept a reduced payment to clear your debt. In some cases, the IRS may agree to reduce or remove penalties if you have a valid reason for not filing or paying on time. This is called penalty abatement. Common reasons include serious illness, natural disasters, or other circumstances beyond your control. You'll need to provide documentation and a clear explanation to qualify. It's always better to file your tax return on time, even if you can't pay the full amount. Filing avoids the late filing penalty, which is much higher than the late payment penalty. You can then work with the IRS to set up a payment plan or explore other options. Ignoring the problem only makes it worse. If you're struggling with your taxes, communicate with the IRS as soon as possible. The IRS is more willing to work with taxpayers who reach out and explain their situation. Ignoring notices or avoiding contact only leads to more severe consequences. Open communication can help you find solutions and reduce stress. The best way to avoid all these problems is to file your tax return on time every year. Set reminders, keep your documents organized, and seek help if you need it. Staying proactive can save you money, protect your credit, and give you peace of mind. Prevention is always easier than dealing with the consequences later. Not filing your tax return can lead to a wide range of serious consequences, from financial penalties and lost refunds to legal trouble and lasting damage to your credit. The good news is, it's never too late to take action. By understanding the risks and taking steps to file, even if you're behind, you can protect yourself and your future. Remember, the IRS offers options for those who are proactive. Don't let fear or confusion hold you back. Take control of your tax situation today.